Hello, everybody. Welcome to a fun webinar today, all about getting cash back on your taxes and something called cost segregation. And probably people are wondering, what the heck is that? So I want to welcome you to LeAnn Riley's Real Estate Investing Club and just say hi to everybody. And we broadcast live every month, though I've been doing it weekly lately, with expert speakers that are leaders in the real estate investing world. And what's great is you get to ask questions, so we're a lot different than a podcast. And the truth is, you don't need a ton of money or knowledge to get started as a real estate investor. You just need to know the right formulas and follow a system to be a smart investor. So I'm LeAnn Riley, and I'm a broker and a real estate coach, and I help clients buy, sell, and invest. And I also lead the Encore investment team, and that's a team of realtors in the Twin Cities, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, condo development, commercial, and vacation properties. And as a national coach and trainer, I help ambitious people build wealth with real estate and using my proven profit formula coaching program. And I provide free education on these webinars to people who care about real estate and are trying to build wealth. So I'm really glad you're here with us today. And today we have some special guests. We have Craig Wanamaker and Warren Dazzio of Cost Segregation Services, Inc. And today you're going to learn how to facilitate maximum tax savings for your real estate related business. They're going to teach us how to increase cash flow, spend less on taxes, stay compliant, and hey, don't throw away money. So I'm going to get to their introductions in a second. I got excited about this when Craig kept calling me. And, you know, even though I'm an experienced investor, I wasn't quite sure what cost segregation was. And he kind of explained it a couple times when I ran into him at some meetings, but I was still like, okay, I get it. But that's for the big guys. What about just somebody with a duplex? How's that ever going to help them? And then he explained to me how it can even help the little guy. And now my ears perked up a little. And we began talking about how it could help. And I'm excited to bring you something that can make a difference right now. And what's really important is the CARES Act has something that affects cost segregation, and we're going to figure that out today. So first, I want to tell you folks that it's in the chat box, and you'll see chat there, and you can light it up to your side, is where you'll be able to ask questions. So somebody try out the chat box, just tell me who you are and where you're from. I just want to make sure everything is working before we get rolling. Okay, somebody put something and I didn't have mine on, so thanks. Oh, Steve. I know him. He's a financial planner, guys. And we got a lady from Texas. Okay, good. The chat box is working. Glad to have that. So that's where you're going to put your questions. And just so you know, we are going to have a slideshow presentation first so we can learn a little bit, and then we'll have better questions to ask, okay? And we're going to try to answer those then after we learn about cost segregation. And before we get started, I want to take a poll. So I'm going to turn on a poll right now, which is really just finding out where in real estate investing you folks who are listening are at. So what you do is just go ahead and answer this on your computer screen. Pretty sure, yep, it's working because somebody's answering, okay. I'll give you a second to do that, and then I'll share the results with you. Okay, it looks like 80% of the people voted. And where we're standing at, we've got, oh, it just flipped. Okay, everybody voted now. We've got about 60% are just getting started. You guys can't see this, can you?
No.
Yeah, so 60% are getting started, 30% are doing fix and flip. We got 40% of the people doing buy and hold. There's some turnkey people and even realtor. So that's who we got on the call, okay, today. And just so you know, this is also going to go out in, there I did push share results. Can you guys see it now?
Yes.
Yeah, there it is.
Yep.
Yes.
Okay. There it is. That's who's on the call. So the winners are the just getting started people. So, you know, I really like that. They're learning about real estate investing and how to do it right before they're in knee deep. So, okay, now we're going to go ahead then, and I'm going to start with Craig. And if you would introduce yourself and tell us something about, you know, who you are and why you know about cost segregation.
Hey, good afternoon. Hope everyone is well and doing staying safe. I live in the Twin Cities in Minnesota, but I get to work nationwide with CSSI. I've gone everywhere from right down the street. Next week, if I can travel, I'm going to go to Duluth. I've been to Arizona, all over the place. So we service people everywhere. I came upon cost segregation by, it found me. I didn't find it. I wasn't even looking for it. And I have a background with loan origination and real estate and business. And I like to use my skills and whatever to serve. And I had to see this thing 3 times before it tumbled in on me. And I just said, oh my goodness, this is a tremendous opportunity to help people. And I have not been disappointed. Every time I turn around, there's more and more that we can do. And since I've been involved, things are coming along like the Tax Cut and Jobs Act, been a huge opportunity. And this CARES Act, again, another great opportunity for us to help others. So I'm meeting people. I'm getting a chance to tell whoever I can. I know that LeAnn kind of looked at me with a doubtful look the first couple of times we met. And I just stayed persistent and said, look, I'd like you to see that there are some tremendous additional tax benefits to go with this. And it's so basic and simple. And so one of the last times I called, like she said, it finally made sense to her. So I'm very glad for this opportunity to share with you guys. I want to go ahead and introduce Warren. I'm very, very pleased that he was willing to say yes, because he has, he had 20 years of experience in the business world before he became executive vice president at CSSI. And he is one of the go-to guys. Just yesterday, they did a presentation with 766 people nationwide that were watching. Tremendous opportunity to learn about this. He works with tax professionals, financial planners, building owners especially. And he has quite a few presentations that he's done. He was here last summer. In fact, we brought him up at the company's expense and did a couple presentations, and left quite an impression in terms of his abilities to and skills in terms of sharing this. And so I'm going to turn it over to him and allow him to share what they were sharing yesterday. Warren?
Awesome. Thanks, Craig, and thanks, LeAnn. Appreciate you inviting us on here. Right now, you can see there we've got contact information on the screen if you have any questions for us and want to ask. But you know, we are going through such unprecedented times right now, and the premise that we're going to talk about cost segregation has been around for quite a while. But the CARES Act just made it a whole lot better for business owners and for building owners. So kind of without further ado, kind of get into this. And I think the burning question everybody has is, how has the CARES Act changed to allow me to have some kind of cash flow? And all this is going to apply whether you own a building or maybe have played for tenant improvements. You know, whether or not, whatever stage you're at in filing your tax returns, if you've extended, if you have already paid, you know, if you haven't paid, and then talk about how cost seg and a partial asset disposition kind of fit into that. And we'll skip through a couple of these a little bit quicker than some others, but kind of get you the core and the heart of what we're talking about, and then we'll kind of open it up for Q&A. But generally speaking, everybody's looking for cash flow right now. You know, businesses are having a difficult time. We're seeing it a lot. No matter the business field that you're in, this shutdown, you're trying to figure out how to pay your employees and keep them around because you know you're going to need them shortly. If you're in the restaurant and retail business, those guys are taking it really hard, and kind of the same thing. What can we do for cash flow to stay alive for now? So that's what we're going to talk about. The biggest thing the CARES Act brings about is the opportunity to get a refund from a net operating loss, and I'll explain how that kind of works. But you can benefit from it immediately from the standpoint of getting a refund back from the IRS in several cases, or the quarterly estimates. If you pay quarterly estimates for 2020, you could do a cost seg study now and apply it to your quarterly estimates. So if you know, hey, I'm supposed to pay $20,000 or $30,000 in taxes this quarter, and you run a cost seg study, and now you don't have to do that, what can you use that $20,000 or $30,000 for? That's the cash flow that kind of opens up to help people that are out there. The biggest thing, and I'll talk about 2 or 3 CARES Act pieces first, but the biggest thing you're going to see is that the CARES Act allows for what's called a loss carryback. Okay, and so what that means is if you create a loss, generally speaking, let's say I have more expenses this year than I had gains, and so I have a loss. That's one way to create one. Another one is a paper loss. You're using a cost segregation study to generate depreciation expense. And if those expenses with your existing expenses are greater than your income, then you have a loss and a net operating loss. So the CARES Act allows you to take that loss and go back 5 years from the current tax year. You can apply this for 2018, 19, or 20. So if you filed taxes in 2018 and you wanted to apply it to that year, you could amend your 2018 tax return, whatever status you're in for 19, or you could apply it to 2020. And let's take 2019, for example. The IRS, the regulations require you to, let's say I've already filed. I'm going to amend my return and do a cost seg study and create a loss. I'll zero out all my tax burden for 2019. Any additional loss left over, the IRS says I can apply back 5 years. They require you to go back 5 years. So this example we show in 2019, you see a loss of $425,000. Paid off any gains that I had, and I ended up with a $425,000 loss. What the CARES Act allows me to do is go back to 14, pay off those $75,000 gains, use that loss to cancel out those gains, use that loss to cancel out $150,000 for 2015, and I can apply $200,000 more to 2016. And if I apply all my tax brackets to the different tax years, the end result is a $115,000 overpayment in my taxes for 14, 15, and 16. That generates a refund check, a cash check from the IRS now for you to put to work immediately. So this has been allowed in the past. The Tax Cuts and Jobs Act in 2017 did away with it, said you can't do it anymore. It's a great opportunity for businesses right now, whether you're owning a building or whether you're a tenant. I can think of several friends that are restaurant owners that they may not own their building, but they've paid for $200,000, $500,000 worth of tenant improvements inside that space. The second thing, and when the IRS in 2017 or Congress did away with all the types of leasehold improvements. They did leasehold improvement, restaurant improvement, and retail improvements. And they called all of those interior improvements qualified improvement property. They wanted you to be able to capture what's called bonus depreciation that I'll talk about briefly. But the way they wrote the law, you could not do that. Bonus depreciation basically allows you to depreciate all the value of those improvements immediately in the current tax year as an expense. So the CARES Act corrects that, and now you can retroactively go and apply qualified improvement property and bonus to anything that you've done since 2018. And what again that does is it increases your loss to offset your gains, and it could either reduce your current taxes now or create an opportunity for a refund. The last thing, and this is just for the CPAs or tax preparers, professionals that might be on the call, is that if you're a real estate professional and you have lots of income from your active real estate work, you could use a loss in the past to offset other sources of income like the stock market. And the Tax Cuts and Jobs Act in 2017 limited that to $250,000 for a single person, 500,000 married filing jointly. The CARES Act takes that limitation, it suspends it temporarily so that now if you have losses like this, you can use that to offset other types of active income. It doesn't apply with passive income. So if you are a doctor by trade and you've got a side business that you own, a retail store that you rent out, you couldn't use it from a passive income, but you can for active. So those are the three biggest pieces. Now, so how does this come about? I mentioned briefly ways that you can create a loss. Who can benefit from this? If you've owned a building, recently purchased it, if you've owned it for 10 years, 15 years, and you decide, hey, we want to apply this loss now if we can generate it. An owner and a tenant who's made improvements, estates. I spoke with someone yesterday. Father passed away. Son and siblings have the remainder of some properties in an estate. They want to create a loss to reduce their estate taxes. People that have triple net leases as well. Typically, people that own multiple properties are going to be the biggest beneficiaries. But we do this every day on little mom and pop shops where people own one building, and it's all relative. I mean, if it benefits you, it benefits you. So how do you gain the benefits that we kind of talk about? We talked about the CARES Act. I've referenced the Tax Cuts and Jobs Act that everybody's aware about. That was tax reform in 2017. The TPRs are the tangible property regs, and those are some regulations that very much affect opportunities where you go and make changes a lot, like a residential rental or maybe a hotel or a restaurant, an auto dealership where the national firm says, hey, we got to refresh your space, or you have tenants that leave and you have to go in and refresh that space again. So it coaches you on what you can expense and what you have to capitalize. A cost segregation study, people have just known it for a cost segregation study, but it provides a lot of the input for you to capture some of these benefits that we're talking about, the CARES Act, Tax Cuts and Jobs Act, and the Tangible Property Reg. So what is cost segregation? The easy answer is the IRS allows you to depreciate a building two ways. In the case of a residential rental, you can do it straight line over 27.5 years, or in the case of a commercial property, 39 years. The alternative is that you break that building out into parts and pieces and identify 5, 7, and 15-year assets. From that, you accelerate those 5, 7, and 15-year assets. Instead of having to depreciate carpeting, for example, a 5-year asset over 39 years, you're able to do it over 5 years. That creates a greater amount of depreciation expense to offset your business revenue, to offset your income. The end result is lower taxes or possibly a refund back, which is what the CARES Act allows us to do. The benchmark is $30,000 to $80,000 per million in building costs. So if you have $1 million building and you can get about 30%, a $300,000 deduction, if you multiply that times the 37% tax bracket, that's $110,000, $111,000 in tax savings that you could potentially get back as a refund or certainly as a reduction. And it can work with very small buildings as small as 200,000. These are the types of things that in a cost segregation study you're breaking out. Our firm, CSSI, is an engineering-based consulting firm. So we have engineers that go in and do that work, and we apply software, real estate and construction software and accounting software to get you to these numbers. But things like decorative building elements, carpeting, flooring, built-in cabinets and countertops, interior doors, those are all 5-year types of assets that you can accelerate the depreciation on a 5 or 7 year. The 15 years are landscaping, hardscaping, paving, fencing, anything outside is typically a 15-year. Sometimes your security lighting would be a 5-year, but and you can see the graph on the right. The blue line is straight line. It's like if you have $1 million building, the IRS says you can have 1/39 of that building every year for 39 years to offset your expenses in the form of depreciation. The red line is cost seg. You're taking out a good chunk of it in the first 5 years, and then it continues to act like straight line. And the green line is what we'll call bonus depreciation, and you'll see that shortly. You get all of that in the first year you put a building into service, and then it acts like straight line after that. So some people think when you do a cost seg study, it takes away all of your depreciation. It's anywhere from 20 to 40%, depending on the property that you're able to take now. And the remainder, you depreciate over 39 years. So it doesn't just go away. A couple of quick case studies we want to show you guys. Here's a a self-storage facility purchased in 2017, around $800,000. It was non-climate control, a $45,000 tax benefit. There's a bigger one that's climate controlled, $3.6 million, the tax savings of $500,000. And this is not the depreciation amount I'm showing you. This dental office was in Florida, a dental friend of mine, a $73,000 tax event for him. And I'll show you a multiple example. This multiple office complexes, they had 12 locations, some purchased as far back as 1999. I think we did this for him in 2017, so that he owned many of the properties a long time. It created a deduction of $5.3 million and a tax savings of $2.1 million. I think anyone right now, even if it was that smallest number, $45,000, $20,000, if it's cash flow that you can use now, that's going to go a long way of helping get you through this difficult time. Another really good thing we like to talk about is called the partial asset disposition. Anytime you're doing an improvement and you're tearing something off of your building and throwing it away, the IRS allows you to write down the remaining basis of it. So let's say I've owned a building for 10 years and I'm depreciating that building 39 years. I decide I need a new roof. So I either abandon the old one in place and put a new one on top, or I tear it off and I put a new one on. The IRS allows me to write down the remaining depreciation of those 29 years that are left on that roof as an expense in the current tax year. There's a couple of criteria about it, but you have to, we call it use it or lose it. You have to take this benefit in the current tax year. The IRS won't let you go back and make the change. CPAs and tax preparers I see doing this for a single item like a roof or an HVAC or an electrical. When you're tearing out sheetrock and studs and carpeting and lots of things, great opportunity to call a firm like ours to come in and capitalize and show you all that you can write down. The cool thing about it is that it lowers the basis of your property so that when you sell, you have more capital gains and less that you're taxed at your personal rate. So there's a tax savings at the time of sale. Another great example of a cost seg and partial asset disposition combined. This auto dealership was asked to refresh things. We did a cost seg on the original building, $130,000, then a demo on the partial asset disposition. Then the renovation is a cost segregation on the improvements they put in, over a $300,000 benefit for that particular client. So it's real money. So now it's kind of the rubber hits to the road. I'm kind of hitting the tail end of this now. So how do I capitalize on this right now with the CARES Act? Okay, the Tax Cuts and Jobs Act. I'm sorry, I got one more thing. The Tax Cuts and Jobs Act added what we call bonus depreciation. And bonus depreciation means rather than depreciate carpeting over 5 years, if I bought or built it after September 27, 2017, I can depreciate all of that carpet in the first year I own it. So instead of following the class life, 5, 7, or 15 years, if it has a depreciable life of 20 years or less, you can depreciate it all in the current tax year. And again, that's why a cost seg study fits very well with the Tax Cuts and Jobs Act. If you're depreciating your building over 39 years, you can't benefit from this. But if you break it down and identify the 5, 7, and 15-year assets, then you can apply bonus to those 5, 7, and 15-year assets, and you can take that depreciation now. Why is that important today? Another opportunity to generate a refund or cash for you right now. Here's a couple of examples where you can just kind of see. We've got the asset class on the left. The property cost is the second column. The first column is if we did a cost seg study without bonus depreciation, you would get, for example, on that funeral home, $19,000 in tax savings in year one, and over 5 years, you would get $37,000 in tax savings. What bonus depreciation does is it skips that first column, and you get the last column as your tax savings immediately when you put that building into service. And that applies whether you bought, built, made an improvement, whatever that is. If you can identify that asset as 20 years or less, you can capture bonus depreciation. Also applies to cars, and we know people that have maybe moving vans if you own a self-storage facility. All those things qualify for some level of bonus depreciation. So kind of talked about cost seg, talked about the CARES Act. Here's a scenario. Let's say I purchased or built a building in 2019, but I've already filed my taxes. What do I do? Well, you can amend your 2019. You engage to complete a cost seg study. amend your 2019 tax return. You have until 2020 to amend that return until you file your 2020 taxes. So you've got a little bit of time. The likely result is if you paid taxes, you have increased depreciation and you'll get a refund back from an overpayment on your taxes. And again, doing this now is going to generate cash flow. Just a note, we've got lots of questions, people saying, hey, if I do an amendment and get a refund, is that going to trigger an IRS audit? And we've talked to a lot of CPAs in 2008 when we had the economic downturn. They all did these processes because the government made it available at that time, and none of them triggered an audit. It's not expected to do so now, so just kind of keep that in mind. But so that's one scenario. I just purchased the building in 19. I've already filed my taxes. You can amend it and get the benefit. I've already filed my taxes. You owned a building for 10 years, 3 years, whatever the case may be. And you filed your taxes in 2019. There's a process called an automatic extension. You don't have to amend the return. You file a form called a 3115 change of accounting form. So you would engage into a cost seg study on your property, file the 3115 change of accounting form, and you've got 6 months to do that. And it's automatically accepted by the IRS. And again, if you paid taxes and this shows an increased amount of depreciation and a loss, then you would get not even a loss, but you would get a refund back from your taxes in that case as well. And another scenario, hey, what happens if I extended? You know, most of the time you have to pay an estimate of your taxes and then you file the paperwork when you extend. Same kind of processes. You would get a refund back if you've already paid. Suppose you saw, you were late in filing, you saw that they were going to extend the tax filing deadlines and you didn't pay at all. Then you could either reduce the taxes that you have to owe or, again, possibly get a refund back. And the last one is, hey, maybe I'm okay right now. I don't have to apply this right now. Well, you could wait until you file your 2020 taxes, do a cost seg on that, see how it affects your 2020 taxes. And in all of these cases, 2018, 2019, or 20, if you made a change to any of these tax returns, you have ability to take that loss carry back and go and get a refund back from the IRS, depending on how you set it up. Just a quick example, we had a particular client in 2008 who was a successful restaurant owner. She had a grand opening on a second location in September. Right at that time, the economy went south. No one was going out to dinner. The restaurant, were struggling. She owed $70,000 in taxes. We did a cost segregation study for her. Months later, she called us. She actually called our sales rep an angel. She said, you guys gave me the cash flow that I needed in order to stay afloat and stay alive. She said, I might have had to close my first location if I wouldn't have been able to do that. So, again, it's an opportunity to free up cash flow, and the CARES Act really is the opportunity to bring that about. I'm going to let Craig take over briefly, and then I know LeAnn as well, but real easy process. A firm like ours, we just ask for a depreciation schedule on an existing building, or if it's a new building, give us the type of building. Hey, I've got an apartment complex. I paid $250,000 for it, and that's separate from my land number. I bought it 6 months ago. Here's the address. With that basic amount of information, we can create an estimate of the tax savings so that you can take a look at that and see if it would be a benefit for you. And the easy answer, we don't charge a dime for the analysis. The easy answer is to run the numbers, and then we can get on the phone with you and your tax preparer to look at it and say, is this something that we can benefit or not? Craig, do you want to add anything to that?
I just had some unique experience. A gentleman came to me and he had a building worth $150,000, and he said, what's available? And because of the Tax Cut Jobs Act at that time, we could do the 100% bonus depreciation. I promised them $8,000 to $9,000 is what the estimate was, and we got him $20,000 instead. And needless to say, he's a very satisfied client. So unless we do the analysis, we really don't know, where we are. And even then, a lot of times we'll come in quite conservative. So we'll either match it or we'll surpass it for the most part. And I don't know about you, but I feel really good when I can do that for someone. And they loved receiving it on that end as well.
Yeah, absolutely. And some quick action items, and then we'll turn it back over to LeAnn for questions. But for building owners and tenants, let us run the numbers for you. We're happy to do that. I'll show Craig, and I think LeAnn's has Craig's data, contact information. He's the best one to call. He is there in Twin Cities with LeAnn. I'm actually across the country in Louisiana. And so I appreciate the fact that we've got people from all over the U.S. on the call. But, you know, use a pre-analysis for a discussion with your tax preparer on cost segregation, partial asset disposition, maybe the QIP if you did some improvements, a loss carryback. Hey, will an amended return benefit me? If you're a tax professional watching, you know, review your clients with buildings for the potential of a cost seg study and qualified improvement property. Does bonus appreciation help? Can they do a loss carryback with their amended return? So, you know, lots of opportunities. I think the biggest one that we get excited about is we help clients and they call us and say, man, that was a lifesaver. And someone might say, hey, you know, and to anticipate a question, hey, it's the same amount of depreciation. Why would I want to do it now? Well, now's when you need it. You know, the whole idea is to take a portion of it now, use the time value of money to invest that. Maybe it's a down payment on another property you're going to purchase. Maybe it's an improvement you've been trying to do and you've had a hard time coming up with the funds to do that. So the timing, it's all about that. So LeAnn, thank you so much for giving us this time. Let me turn it back over to you guys for questions.
All right. You know, it's pretty interesting to me because I guess the first thing I'm thinking is, what's it cost to do this? Like to get you guys to do the analysis, what's that typical cost?
Sure. We so that you know, every building is different, and we do it on a case-by-case basis. But we charge a fixed fee. We don't charge a percentage of savings. The IRS kind of frowns upon that. And so an average cost for us might be between $5,000 and $10,000. For a much smaller building, it might be less. For a much larger building, it might be more. And you know, we want to return a 10 or better return. I ran the numbers for a cost seg study for somebody today, and I want to say the cost seg was $9,000, and they were going to get a $500,000 tax benefit. So you can see how relative it is, and the cost seg fee is an expense as well. So you really, as an after-tax expense, a $9,000 fee would be more like $5,700, something like that. So does that answer that question, LeAnn?
Yeah, that does help. And I'm thinking, you know, the other thing that occurs to me as far as real estate, most people, if you really look, they don't own the building for 39 years. You know, something happens and changes in their life, or the market shifts or whatever. So when you're, you know, this at least, like you said, gets you the money now when you can use it. And especially now with what's going on in our world, and this is a global issue right now. It's a health issue. It's humongous. How many, like when I liked your restaurant story, how many restaurants are going to be able to come back right now? You know, this could be easily the difference of coming back and not coming back for a lot of people in their businesses. I see we got a question from Steve here. If we use Minnesota tax credits, can we also use cost seg?
You should be able to, yes. The cost seg is typically a federal tax. So you can use it with historical state credits. You can use it with federal state credit. You can use it, somewhat. It's limited in opportunity zones. So in most situations, you are able to use it. Craig, you're in Minnesota. You have anything to add on that one?
If you're dealing with what kind of benefits in Minnesota, it's 20% the first year and 16% for the next 5 years. That's how they do it.
On bonus, you mean?
Yeah.
Oh, got you. There you go. Okay, so every state is different on how you can apply bonus. What he's saying is that Minnesota requires you can take 20% now and then 60 every year until you run out of that benefit. But even if you are capturing other state or federal or historical tax credits, you usually can apply. You can't double dip. So like, for example, when we do a cost seg study on a historical building, we apply the historical credits first, and they usually apply that to specific parts of the building. And then the remaining basis that did not receive any historical credits, then you can apply cost seg on that remaining basis.
Well, and then that's what you guys are the expert at, is like going inside the business and saying this falls in this category and this is in that category. And maybe the tax accountant doesn't, maybe without going in and looking, maybe they miss stuff.
Yeah, we work very closely with the tax preparer. There are CPAs that know more than us, and we probably know more than some CPAs. It's always a case-by-case thing. We do have CPAs on staff. We have accountants on staff. And so when we run into a case where a CPA needs coaching, we'll walk them through the whole process. We do that regularly. A CPA or a client will call me. Really, a CPA will call me and say, hey, you guys are doing this cost seg for my client. I'm not 100% sure exactly how do I apply it. And so we'll get them on the phone and walk them through, put this number here, put that number there, put that number there, and everybody wins. We partner with a lot of CPAs. It doesn't do us any good to talk bad about CPAs. They're like everybody in the world. They're phenomenal CPAs, and there are other CPAs that could use a little more learning, and we all fit somewhere in between that. But I think where we excel is our knowledge of that tax law and being able to work side by side with a tax preparer to get the right answer.
Okay, I'm
one of the guys that's pretty good at that, but as Craig knows, we've got a back office with quite a few people that know much more how to apply it on a tax return than I do.
I'm thinking, when you touched this, but I'm not sure what it meant. But now, if I take all this depreciation now and I sell the building 5 years from now, aren't I going to have to pay the penalty?
You do have to pay it back. You have to pay what's called recapture. You'll
Right.
never have to pay back more than you took out from a cost seg study. So that's the whole idea. One of the guys in our firm refers to a cost segregation study as an interest-free loan from the IRS. So you take the money out now, you use the time value of money to put it to work for you. When you sell that property, you have to give it back. So we would say, what are the reasons where you wouldn't want to do a cost segregation study? If you know you're going to flip it in a year or two, it's probably not the best thing for you. If you know you're going to have it for 4 or 5 years, then you've allowed that interest to accrue and you've got something out of it, and then you've got to pay the original principal back. You can also reduce recapture by diminished value. So for example, if I've owned a building for 10 years and I did a cost seg study on it, I reasonably could say my carpeting is a 5-year asset and I've owned it for 10 years. It's not worth as much as when I first bought it. So you can diminish the value of that 5-year asset, and you can go through the items that we identify in a cost seg study. Some things are going to diminish a lot. Like if you're in a self-storage facility, the metal walls are not going to depreciate. Their value is not going to be significantly lower, but appliances and carpeting and maybe your asphalt parking lot, all those are things that are going to get wear and tear on them, and you're reasonably able to assign a diminished value to them when you sell that property. So you can't avoid it completely, but you can reduce recapture on the back end.
Well, and then if you're going to exchange the property, does that factor, if let's say you're building up with 1031s, that still will hit you, right?
It will, yes. And what we see is the 15-year does pass through a 1031 exchange. The 5-year that you peel off does not.
Okay.
And so the two ways that you can address that is number one, like I said, diminished value. But number two, we get lots of people that will say, hey, I'm doing a 1031 exchange. I have $500,000 basis remaining after the exchange. And we do a cost seg on the second property, and that often offsets the recapture from the first property. So again, you're kicking it down the road, but there are many people that do 1031 exchanges again and again and again and again and just push it forward. Now, the true way that you avoid all that is that you pass away and you have you have assigned all that to your kids.
Yep.
What triggers recapture is a sale. And since in an estate pass off, a sale never occurred, then the kids don't have to address recapture. And in fact, they can do a cost segregation study on the new basis of the property they just inherited in the trust. So that's kind of the way some people plan on addressing and dealing with that.
Absolutely. And that is sophisticated real estate investors, you're right, they never pay it, you know?
Yeah, I had a guy that was selling, well, I ran the numbers on a cost seg study. It was going to generate a $2 million tax savings for him. And he said, well, I'm thinking about flipping this property in a couple of years. And I said, oh, well, do you still want to do this? And he said, heck yeah. He said, I know that if I invest this $2 million back into one of my properties, I can make about 12% return on that. $120,000 a year, $240,000. I'll take that if I have to give the $1 million back and recapture any day. So in the meantime, he's made money on that cash that he put to work for himself. So a sophisticated taxpayer will really look at that and use it for his or her advantage. You're right.
Well, and if we look at the housing market and what's going to happen, and we all know something's going to happen, and I just did a webinar last week. I say it's going to be more like a V. It's going to be a big old drop, but it should spring back fast. And if you can get cash to use right there at the bottom of the V, that's the people who really, really can build the wealth. And so, we have to use all of these programs available to get that cash, is how I see it. Cash is king.
It is. And there's so many different strategies that are out there. What most people are hearing about is the PPP, the payback, paycheck payback plan, and the SBA loans. And this is another great opportunity if you own your own building or if you paid for your improvements. Hopefully we'll find 2 or 3 other opportunities, kind of the same things. Is, well, what are the ways that we can put cash in our hands now so that we're doing good on the other side of this, and that's really what everybody's trying to plan for and hope for. Now,
what if I had a restaurant and now I'm clearly and I did the $300,000 of improvements, and built it all out. And now because of what happened, I know I'm going to have to close. I can still do this and go back and recapture something, or no?
Now you're kind of talking about bankruptcy proceedings.
Well, no, I'm just maybe I'm not gonna go bankrupt. I can be flush, but can I maybe still get something back on the taxes from the past because I spent all that on the...
Oh yes, absolutely. So that's the whole point. The thing we call qualified improvement property. I don't own the building, but I run the restaurant, and I spent $200,000 in improvements in 2018. You can go back and amend that 2018 return, apply bonus depreciation to that qualified improvement property, that tenant improvement that you made. And then if that creates a loss, then 2 things happen. Number one, if you paid taxes in 18, you probably would get some money back now. Number 2, if it creates a loss, you'd get money back for 18, and then you could apply that back to 2013 and roll it forward until it zeroes out your tax liability there as well. So no, absolutely. If you're going to plan on trying to stay around and you made improvements, bought a building, haven't done a cost seg, all those type of things, the time is to talk to your CPA or tax preparer, to talk to us and let us run the numbers. So then the best thing to do is let us run the numbers. Then you've got something in your hand that shows this is an estimate of the taxes I think I can recoup. Then you take that to your tax preparer, and that tax preparer says, hey, yeah, this could work. I may not know how to amend this return, or I may not know how to do a loss carryback, but I know I can find the answer, and we can take these numbers and get that benefit for you. Most CPAs or most tax preparers are going to be well aware of how to do all that. An amendment and a loss carryback is not a new thing. It was allowed prior to 2017. They allowed you to go back 2 years. And then when the Tax Cuts and Jobs Act came out, they got rid of it. Now they're offering it again for a logical reason. If it's going to generate a refund to people and keep their businesses open now, as much as we want to get political and talk Republican or Democrat, there's some smart things in this that are trying to put cash flow in people's hands. And the whole idea is to help them stay afloat during a difficult time so that they're whole on the other end, to keep employees working, to keep their businesses running, and I think that's a good thing. This is an example. We could look at it and say there's a bunch of crazy things in there, but this is a pretty good example that are going to help common people and, very sophisticated people with their taxes right now. So it's worth pursuing.
So, okay, anybody got any questions? Go ahead and put them in the chat box, okay? Because we got some experts on here we get to ask. So,
and Craig, maybe a question that you get all the time that we could answer or address. What's one question that people ask you in your dealings with them when you talk about a loss carryback or a cost segregation study, anything along those lines?
Part of it, I go back and I talk to them about, in a sense, who is CSSI? Because one of the questions you say, can I trust you? And so I share about the fact that we've got a long-term history. We've done 22,000 of these and never triggered an audit. If we've had people that did have audits, we went in and helped them at our own expense, never had a problem. I try to reassure them who I am or what I'm about and that we have their best interest in mind. I think that's one of the more important things. And I remind them too, we're all part of a team. When I brought some people into working at CSSI, one of the biggest impressions they had is, I've never met such a group of people that want to network and help one another as we help your clients. And that has been a huge part of this whole thing. That was a nice surprise that I had not anticipated, but I'm so glad that it's there. I think that's very important.
Yeah, and you touched on several things. Is this an audit risk? No, it's really not. We've done somewhere in the neighborhood of 22,000 cost segregation studies. It's never triggered an audit, but we've had to defend about a dozen clients who were audited for other reasons, and they all ended with happy client, happy IRS. That's a great one. Who do we have working on it? We've got a big team. It's not just Warren and Craig. It's engineers and accountants and project managers and project coordinators. And the process is a good question that sometimes people ask is, we create a pre-analysis. If a client says, yes, I'm interested in moving forward, then they pay us 50% of the fee and they complete the paperwork for us. And it's just a 2-page engagement. Hey, give us some details on your property. Then we ask them for a certain amount of detail. Do you have blueprints? Do you have any kind of invoices? Do you have an appraisal? Share us your existing depreciation schedule, or if it's new, we'll help your CPA create that. We do a site survey of every property and go in and document that property with pictures. And we've had to be a little creative with the coronavirus issues going on right now and being sensitive about going into people's space and going in. So that's come about. But takes us, once we get all the data from our clients, it takes us about 6 to 8 weeks to complete a study. And then we sit and walk through you and your CPA to arrive to the right solution. We've got quite a staff that knows exactly how to apply it and get to that end result, which is cash flow in your hands. And whether that is a reduction in taxes, I did this so I don't have to pay as much, or whether that is I'm getting a refund check now, each way you win. I speak with bankruptcy attorneys as well, and the government always wants their taxes, so when coronavirus is done with, the government is still going to say, you owe us, so if we can reduce that amount now and have good things happen from there, then you win. Or if we can get you cash back in the form of a refund, in both ways you win, so that's, it is. And it's like Craig said, we have an amazing team, wonderful people. It's a great place to work, and we all kind of watch out for each other and help each other out. But as a collective whole, it's a pretty efficient team that we have to help our clients and the tax preparers get the work done.
I see we have a question here. The landlord owns the building and the tenant puts in the improvements. It was a restaurant. And the tenant wants the benefit because they paid for those improvements. Is the study on the entire building, or is the study on the improvements?
We break them out all the time. Sometimes we get the landlord that will call us and engage, and the landlord will say, hey, I've got a tenant that they paid for improvements. Can we split the fees? And the tenant will pay some and the landlord will pay some, and we'll do the whole thing. We typically will do the whole building. Sometimes the landlord will say, this guy doesn't want the benefit, but no, we can do any and all. Sometimes we have just the restaurant owner says, hey, you know, the landlord is in a different thought process than I'm in, but I want to do the tenant improvements alone. And so we'll do the tenant improvements, or sometimes we'll do both. Sometimes we'll do the building and not. So yes, the answer to that is both of the above and all of the above. We can do it any way that they prefer it being done. Absolutely.
Interesting. This is now for the smaller guy. You know, would this work for short-term rentals? Take the Airbnbs. They're going to take a major dive right now, right? Compared to wherever they were. Like it, you know, it stopped their business. And so they'll have this big loss this year. Is there a way to, like, will this work on something like that?
Yeah, we've done quite a few Airbnbs. Yeah, absolutely works for that as well. And the thing about it is that last year they might have had a great year. And so that's the beauty about a lost carryback, is that they could do a cost seg on it now, amend 2019 and get a refund back now to get them through this difficult time. Once the travel starts back up again, then they're going to have more revenue. Or, you know, if they said, hey, I'm okay for right now, I'll apply this loss to 2020. So you can do the same thing. They could wait and take the loss in 2020 and apply it back to 2016, 2015, excuse me, or they could do it now. Most people need it now, you know, and most people are going to say, I'm going to amend 2018 or amend 2019, and I'm going to get a refund check right now. That's what the large majority of the people are going to be doing. So there's going to be lots and lots of amendments, and I can't imagine that the IRS is going to target it more, because now you got to follow the rules right, and your tax preparer should be able to do that. And again, we can coach them through that, but you know, I think a lot of people are going to take that option. But yeah, we did. I'm aware of several Airbnbs that we've done in the recent past few months as cost seg studies. So yes.
Yeah, and I can see that, you know, boy, it's confusing to the average person. And I know a lot about real estate, so I just would say we need professional people like you to handle it. It's just like right now, the PPP and the, you know, all these things are out for people. And that's what I've noticed the most. You know, lots of business owners are like, they just want to throw up their hands. They're like, I don't get it. I don't know how to apply. I don't know how it will work. And they're so confused. It's adding another layer of pretty big stress to people right now. And so I just encourage even those people. I was on a conference call this morning. That's what I encourage. You know, somebody said, if you want to figure out, should you do unemployment PPP or what's the other one, like ELSA, or what's it called? Economic assistance. Anyway, there was a guy on a webinar for $300 a firm, you know, that's their cost. They'll figure it out for you. And you know, that's the answer to some people. And like for this cost sake, it's like, for God's sake, get a professional company who you do this all day long and you know how to do it. And then you'll tell us, you said in a preliminary thing, if it's even worth like going the full boat, because you can tell with a little look. Much like us realtors can, you know, we just need to see roughly the house and we can tell you if you should fix it or we can sell it now.
What do they call it? Yeah, love it or lose it, love it or leave it, one of the others. So yeah. And, you know, and everybody has their specialty that they're good at. This is what we're good at, and it just so happens that the process that we do now is a great input for the CARES Act to get something back from that. So, you know, I mean, if you're a business owner out there, I would be looking at the SBA loans. If you own your building or own some improvements, I would look at this. I would look at the stimulus package there. You know, and you're right. It's kind of like a minefield going through the different pieces. I can't tell you anything about the SBA loan process, but I can tell you a lot about this process, you know. So choose the right expert that you want to work with and ask them to help you in that area, whether that's the stimulus, the paycheck thing, SBA loan, or whether that's cost segregation and a lost carryback. And you know, if any of those or all of those can help you, I would recommend you guys at least running the numbers on everything and pursuing it and seeing, is this a good fit? I mean, that's always the right answer. I talked with a building owner yesterday. I explained what we did. he was the gentleman that had the trust that he and his siblings were in. And he said, all right, let's talk again on Thursday. I'm going to have my tax preparer with me. I'm going to be in his office, and we want to have another discussion with you to see if we can benefit from this. So, that's the right answer, is just, get your advisors close to you, look at all the things that are out there and see if each of them fits for you and the timing is right for you.
Okay, we got any more last minute questions? Anybody? Type it in the box because we are rolling here toward the end. Just so you know, lots of people couldn't come on, and I'm going to put this out to, for anybody who's watching later, I'm putting up a slide now that I'm going to share my screen.
I'll stop mine.
Okay.
There
I
you
thought
go.
they were looking at us all this time and they weren't. Let's see here. Here is.
Now you can share your.
Yeah, can you see
There
it?
you go.
Yeah,
Yep.
Here's how we contact Warren or Craig. Like Craig's here in Minnesota and he works in all the states. There's their contact information, their Gmails, and that's how you can get this started or ask further questions, figure out if it's for you, or if you know another business owner or real estate type person that missed out on this, give them Craig's information and they could maybe be helped.
Yeah, if you guys have an analysis, if you want us to run the numbers, send that to Craig. If maybe you have a technical question, send that to Craig or I, and between the two of us, we'll get the answer for you and get you some numbers for you to look at.
Okay, and then I have one more thing here. I'm doing another webinar next Wednesday, and I just want to tell you about it. It's really kind of cool because the world is changing. Like I said, this is a global issue. And down to our own self, our families might be changing just in the sense of spending a whole month or two, tightly. There's a lot of divorces, there's domestic abuse, there's some issues going on right now. And so I brought in a speaker here. His name is Peter Redding, and he is a visionary and life coach who runs the coach training program called Coach for Life, which is actually how I'm originally trained. For over 20 years, I've been a master certified coach, but he has this cool technique. It's called Core Self. And in that 1 hour call, you can actually run through the process because it's a training. And it's to figure out, who am I? And where am I going? And I think those are really critical questions right now. People are refocusing on what's happening in their own world and in the world of their career, or, it's time to refocus. Some people aren't cut out to work at home and, they're struggling a lot. Then I've worked at home for 25 years. This is like kind of normal for me, but I spent years learning how to do it. So I just want to tell anybody, you'll be reminded if you're a member of the Real Estate Investing Club. It's free, and would love to see you here next week. So thank you so much, Warren, for taking the time, and Craig, to explain to us about Cost Seg. And I learned a lot, and it's something that I'll be telling my people about. Hey, did you check this? Because I teach wealth building through real estate, and we have to know all of the angles to be able to grow that money. And having it today is a huge angle. To have that cash now when the opportunity is here and redeploy it. I teach about the velocity of money, and this is it right here. So thanks so much for contributing, you guys, and I hope everyone here, please be safe and be well.
You bet. Thanks very much, LeAnn.
All right. We'll be talking.
All right.
All right.
Bye.